I just jumped in.
That's fine. Good morning. We are at the work session on, and I forgot my date in front of me that I usually have, February 10th, 2026, and I call the work session of the Economic Development Authority of New Ulm to order. And we are here to discuss two of our programs.
All right, Madam President, Commissioners, like I said, we're going to start with the review of the EDA's Commercial Property Rehab Loan Program. This program's been around for several decades, and I've invited Community Development Director Schnobrook here to give us some history on this program.
Okay, thank you. Good morning. My name is Dave Schnobrook. I serve as the Community Development Director. Back in June of 1977, I joined the city as the planning housing assistant. And so half of my job was associated with planning, the other half was with housing. Our housing program at that time was 50 certificates, and from that, the program grew. Anyway, in 1979, the city again applied for a grant through the Small Cities Development Program. That was federal money. And at that time, we dealt with the HUD office in Twin Cities, which is probably the same office that Heather currently deals with. The program has since been taken over by the state of Minnesota, DEED, so that's who you would work with if we were involved with the program today. And the program still exists. The city had made several prior attempts to secure funding through this program and was unsuccessful. This time we were successful. We applied for what is called a comprehensive grant, which meant that we could finance multiple activities. And we also had multiple years in which to expend that money. So in 1979, the activities that we identified that we wanted to finance were the construction of a senior center activity, or a senior citizen activity center. So that's the building that's currently located on North German Street. We wanted to give assessment grants for the sewer separation project. At one time, the city of New Ulm had a combined sanitary sewer, storm sewer system that served our downtown area as well as the periphery of the downtown. So we had residential units that were part of the area as well as the core of the downtown. We were going to make a contribution to the cost of that improvement or that separation. We acquired the site for the Broadway House. And finally, we did housing rehabilitation. Now, the housing rehabilitation that we did, we strictly used our own money for that. Over a 2-year time period, it totaled $115,000. And so in October of 1981, we made our first loan. We expended all of that money in a fairly quick period of time. I should note that, again, we had a project area, and that was this sewer separation project area. So it was limited to certain residences, certain property owners. We then in 1983, we transferred, and I had to go and look at our records, and I hope this is accurate. We transferred $190,000 into this particular program because of the amount of interest that we had at the time. I should note that all of this money that we received went to the City of New Ulm. City of New Ulm basically transferred the responsibility for the administration of the programs to what was then the New Ulm Housing and Redevelopment Authority. Housing and Redevelopment Authority became the EDA in '94, I believe.
Somewhere around there, yeah.
So we initially, kind of focused on project area and the residential units within that area. And we kind of reached a point where we had kind of saturated that particular use. And we, in 84, or from 84 to 85, we had still a residential rehab loan program. From 86 to 91, we had a commercial residential loan program. At some point in time in there, we expanded the program to include properties throughout the entire city. We didn't think it was appropriate just to focus on the downtown area. And then from 91 to 2007, we turned it into the commercial property rehab loan program, and I believe that's where you're still at. And so during that time, we've got a list of all of the loans that we've made, and I don't know. We at some point in time, maybe 5 to 10 years ago, we were at 120 loans. I'm sure, obviously, it has increased since then. It was the loan repayments that built the balance in the fund. We did have periods of time when we had limited interest in the program, and so we would adjust terms and interest rates and activities to try to generate interest. We worked with the Chamber of Commerce to make the program available or let people know about it. So it hasn't stayed as a static program, but has changed, I guess, basically to meet what we thought the demand was within the community. When we first started off,
Dave, can I just jump in? I just pulled up our report from our meeting this month. We have issued a total of 165 loans to date, and there are currently 38 active loans.
Yeah. When we first started off, the very first program was one that was based on the premise that if you stayed in your residence for 5 years, your loan was forgiven. If you stayed for 4 years, you had to pay back 20%. If you stayed for 3 years, you had to pay back 40%. So it was a graduated schedule. The idea was that we didn't want people applying for the program, being successful, rehabbing a building, and then promptly putting it up for sale. that wasn't the purpose of the program. It was for to benefit the people that that live there. So that's kind of a capsule statement of where we started from and how it has evolved over time. Be happy to answer any questions if I can remember a good answer.
Thank you.
Any questions for Mr. Schnobik? Thank you for your report
Okay.
and diving into history.
Yes.
For those of you who don't know Dave, he is our historian. He knows where to find all the history on all things city. I sent this, the program guidelines out to you to review ahead of this meeting. I also did, I met with Dave and John Nisley, city planner, last week to get their input on the program, and we have a few, I wouldn't call them recommendations, but topics of discussion, I'll call them, for today. But I don't know if you want me to start with those or if you want to start with you want me to start with ours. Okay. So one note I made on this program is historically, since it started up until about maybe 5 years ago, we required there to be lender involvement in order to get this loan. If you had a project, we'll just say, for the sake of discussion, a $100,000 remodel project, you would borrow half of that from a lender, a local lender here in town, and you could borrow the other half from the EDA. About 5 years ago, we changed the requirement that there didn't need to be a lender involved. You could self-fund half the project if you had the ability to do so, and you could still borrow half of the project costs from the EDA up to our limit of $75,000. We had a discussion about potentially going back to requiring lender involvement, and there's two reasons for that. One, they're vetted by a bank. They're considered to be a good credit risk. If the bank is willing to lend them money, we feel safer, in turn lending EDA funds. And then the second thought I had on that is to potentially make this a program that is for gap financing only. So if the lender can't borrow them the full amount of the project, for whatever reason, and there's a gap, that the lender would then refer them to the EDA for gap funding. That would be a change to the program. It's just something I'm throwing out there for discussion. I'm not saying that's what we should do. I just, it's a thought I had. That's the way the Brown County Economic Development Partners run their loan program. From what I understand, lenders will say, this person needs to borrow a little more money than we're willing to borrow them. So there's a gap. Can you lend them the rest? Just throwing that out there. If we're not going to go back to requiring bank involvement, then I would like the EDA board to set a minimum credit score that I would go by for loan approval. Right now, we don't have that, so I have to decide if their credit score is good enough for us to make the loan, and I would feel more comfortable if there was a set criteria that I would go by. And then right now, loans over $50,000 need to come to the board for approval. So like I said, they can borrow up to $75,000. I don't know why that was put into place about 10 years ago when we raised the amount from $50,000 to $75,000. Someone on the board felt like that's a lot of money that should have board approval. I would like to consider removing that requirement, because if the applicant meets all of the loan criteria, on what grounds would the board deny their loan anyway? and it's never happened. I've brought it before the board. They've all been approved. It's just an extra step where they're having to wait until the next board meeting, or we're having to call a special meeting. I just don't see the point in it, because if they qualify for the loan, why would we deny it at a board meeting anyway? And then in the EDA strategic plan on page 57, in regard to this program, they wanted us to consider adjusting the interest rate. It's currently at 2% for these loans. Do we want to consider changing that to what current interest rates are, or do we want to leave it? Again, I'm not saying we should change it. They just wanted us to have a discussion on it, and Mike might have some input on that, or Nicole, as far as what do we earn if the money's sitting in the bank versus what we earn for money that's out on the street in a loan. Is that something we want to look at, or do we want to leave it at 2%? So those were the items I had for discussion.
Okay, let's take those kind of one by one. The first one requiring involvement, or sorry, that we have to have the bank involved as well. I did see when I was reviewing the documents that you could self-fund the half, and I had the same question. A bank is really good at vetting and underwriting, and it's much more than just a credit score. I would be okay with saying we need to have the bank do the other half of the financing, just so that we have more ability to understand what their my words are not my friend today. Just so that it's just an extra layer of preserving our money.
Is anybody self-funded?
We've had a few, and I have to say we haven't had any issues with them. Whereas we do have a loan currently that was vetted by a bank that is in default, and we are in court proceedings at the moment to try to get a settlement on that loan. So it's not a 100% catch-all that they're going to be creditworthy, just because they've been vetted by a bank. And over the course of the years, there's been a few loans that have defaulted, and the ones that are longer ago, before my time, those would have been vetted by a bank. So it doesn't mean they won't default. Just throwing that out there.
Go ahead, Mike.
So if the program, I don't know if the program is intended to be a gap or not. To me, if you're self-funding, you probably don't need the gap. So that's the other part you got to look at. Is this for anybody to rehab, or is it for people that need the help to rehab? Because I would guess if you can self-fund, you can probably get the other half from the bank.
Yeah, right now it's not meant as a gap. Would we want to consider going to that? And I'm not saying we should. I just wanted to see what the board's wishes were on that.
I think in regards to requiring the self-funding, like I know that we have an active rehab loan, commercial rehab loan that we self-funded like 5 years ago.
Are you talking Turner Hall?
Yeah. So we had a kind of an emergency with some brick and a tree growing out of the side of the building. And so we self-funded. I don't think that we as an EDA should put all of our eggs in relying on the banks to do the vetting for us for two reasons. Number one, the banks and the credit unions, they're going to be looking out for their own risk. They're not looking out for the additional risk for us. While it's a good thing to go on, having them lend what they'll lend, and then they can come to us for the rest, and we serve as kind of that gap. Like that puts a lot of risk on us, even though it's, we offer a lower interest rate. So I would say if somebody wants to self-fund a portion of that, but they need help coming up with the rest, and they're looking for something that they can do with a lower interest rate, they're going to be rehabbing a building, and investing, I guess in their own business and the community. I think we need to look, and I've been saying this for a long time, we need to look at how to assess our risk here. So whether that's using like business credit reports or personal guarantees or a combination of both, like if we are lending the money and we are the lender, we need to be assessing our own risk. And then just going back to over the 50, well, we'll get to that later. But I do think that we need to be careful about saying, well, let the banks lend them what they're comfortable to, and then we'll kind of take on the risk of the rest. And if the bank vetted them for this amount, they're probably good for the rest. You know, that is, to me, is not a good formula. And like, I'm very big on kind of risk assessments and that kind of stuff. So I don't know, Mike, if you have anything to add to that.
It comes down to what's the program's intention. That's what we need to decide. I could go either way on that. Are we professionals? Are we the bankers? You know, that's,
Well, and that's a good place
there
to
a-
start. What is the intention
is
of the
there
program?
you know, when we get to the 50, 75, my only comment on that would be is what fiscal responsibility do we have as a board? We're not making that decision. Can it come back to us?
Yeah, I mean, for all of our other programs, the EDA has set guidelines and criteria, and they've left it up to staff to administer the loans. This is the only program that if it's over that dollar amount, I have to bring it to the board. And I wouldn't bring it to the board if they didn't meet all the criteria for the program. So again, on what grounds would the board deny the loan at that point?
You know, looking at the strategic plan and what our planners wrote, they did write that it addresses the capital for expansion by filling gaps with the lower interest rate and flexible terms. So that seems to be their recommendation. Not that we have to follow their recommendation. We have to do what's best for New Ulm and what we know. But I do like that idea of filling gaps so that people who can do it on their own, they don't just rely on here's easy funding, but that we preserve that capital for truly in need businesses who might not otherwise be able to expand or create a business here in New Ulm.
And getting back to what Heather said, I think when you asked on what grounds would you deny it, maybe kind of on the baseline of when we were doing our $10,000 grants. Do we need more daycares versus hair salons? That would probably be the only basis you would deny something. I mean,
But then that would have to be in the criterion before it ever got to this level, so that staff could vet it according to what we say are the priorities of those.
yeah, so then there would probably be no need to bring it to the board, I agree. If it's already meeting, unless we change something.
So
Did we jump from one subject to
We did.
another?
We did.
So can I go back for a second to, can we use the example that you're dealing with right now with a loan that went into default that also had, you said, a bank match, correct?
Well, and
Or a bank lender and the E EDA?
that's not one of these loans. That's just a loan the EDA has that's in
Okay.
default. That was,
So let's
it's
say
not a commercial
hypothetically,
loan.
there's a bank lender and the EDA, and it's a match. The bank has first position, so the loan goes into default, and now you're in court proceedings, you're trying to recoup. The bank is always going to be first. So in that scenario, what are the possible outcomes for the EDA? Is it even, at what point are you confident that you're going to recoup anything? And that's
it would
just
depend on the loan and what they put up for collateral. I mean, we could get a tractor and then have to sell a tractor and
Right.
whatever that's worth at
Yeah.
that point. So it really depends. We try and do, real estate mortgage, but we're always going to be second, third
Right.
position, depending on what type of loans are on there. If it's for equipment, collateral on that. So nothing's guaranteed, at least on the EDA side, because we're always going to be in second position to everyone else.
So then that maybe makes more sense to be a gap funder, knowing that there's at least going to be a little less risk or less loss.
Right.
Should someone go into default, we're not matching the bank, we're financing a gap where, and I mean, anytime I've worked with the bank, they've also required at least some form of capital investment from myself too, so you have some skin in the game. So when you go through those channels, then this would help someone who's, I'm close, but I'm not quite there. I need an extra 30,000 to make this whole project work. On the opposite coin of that, opposite side of the coin, if you're looking through the lens of the borrower, this program definitely, if it's a match, is going to set you up for greater success when it comes to cash flowing your business because your interest rates are not fantastic, and this is a great way to save money. So is the intent to protect our own funds, which needs to be present to some level, of course, or is the intent to set the borrower up for the greatest amount of success in terms of cash flowing a brand new business? Because if this is a commercial program, it involves business too. So there's two sides to that.
Yeah,
I would-
so this does not look like a match. We're
No.
funding 50% of the loan amount.
It's
So
up to
it's-
50%. So, or up to 75,000, 50%, whatever is.
But I'm guessing most people, most borrowers are going to do the 50% to get the savings
Right.
Yeah.
The
interest
rate.
rate.
Yeah,
So
the-
yes,
the-
it's up to, but even a bank is going to say, well, let's match that and save you some money.
And I would say, my economic development brain is always going to err towards your second point. The whole point is to get people to rehab their building. And whether they have money in the bank and we're, or money on hand and we're the other half of that to help them get there, specifically with the cost of construction, the cost of property tax going up, the values of their building, everything is being compounded, and for them to rehab their building is always going to be kind of bottom of the barrel. If this gets people to rehab a downtown that is aging, walk in between Lola's and that building. I'm surprised that building hasn't fallen down yet at this point. But that's kind of what that money is there for, so people can take advantage of it because of the lower interest rate. But again, whether it's GAAP or we still keep it the same, really up for this board to decide. But I'm always going to err towards, yes, let's get the money out there for the people that want to rehab their buildings.
So are you saying it's more of an incentive for people that could maybe do it financially but aren't going to, but now they see an incentive with a lower percentage loan? So then it wouldn't be gap as much as it would be an incentive.
Yeah.
Which, yeah.
Want to maybe offer a comment that I was associated with the program probably through 2007, 2008. Tom McCauley, who was the administrative assistant city manager at that time, had primary responsibility for the program. We always worked with the bank, primarily because none of us had that type of experience on the staff to be able to make those kind of decisions. But we did have the discussion of if someone wanted to bring in their own funding to pay for their portion, that would be acceptable. We never quite went that far. The example that sometimes would be brought up is that someone could take out a loan from a bank, and the next day after they closed on the loan, the next day they could walk into the bank and pay the whole thing off.
It's true.
We also did not have a lot of defaults. Matter of fact, I have difficulty remembering more than one or two in that entire time period. So we always had good applicants, and they paid their loans off. I do remember we did have one in which our collateral was a car. So, you do have those kind of situations. One other thing I wanted to follow up on, I thought was a little bit of discussion about, and that was this program originally kind of focused on the downtown area. And when I look at the downtown area, and Mr. Christian can speak much better to this issue than I can, there's the need for some help in that area. If we want to maintain, historic structures, we're going to have to come up with some way of doing
You
it.
know, a comment I'm going to follow that with Dave. Dave, was it what, 15 years ago? We got all that money for downtown renovation. Believe it or not, we gave some of the money back.
Yeah.
There wasn't a lot of interest from our downtown owners to fix their buildings. We were shocked that we had some take advantage of it. Others, free money, Dave, right?
Do we know why that is?
It was a combination
Yeah, a
of,
combination of-
there was some loan, there was a part, they had to put in their own equity, and then there was ours,
Right.
yeah.
But I mean, we gave money back, there was no interest.
That
So
is-
listening
that
to
is right.
everybody's comments here, I want to go back to, what's the purpose of the EDA on this program?
Right.
I realize you're worried about lending institution, are we a banking facility? Technically, yes, technically, no. Do you take the gamble? I believe we should. It's economic development. I mean, are we gonna lose once in a while? As Dave stated, we've had defaults, so have banks, right, Mr. Lee?
Absolutely, maybe a whole list.
So in my mind, we're trying to rewrite a program that has worked for the last 25 years. I get the gap, I get all of that, but
I'd agree with that the purpose of this would be to set people up for the greatest amount of success. And
in my mind, those coming in that want to tackle a program are interested. I won't name the buildings downtown. They had no interest at all. Buildings are falling down. They took no interest at all in the program. So, I mean, if they're coming to the EDA or to the bank, they're serious about, I want to rehab. I want to try this. Things go bad in today's economy? Sure they do.
And some of those downtown buildings are finally starting to change hands, and the new owners are wanting to rehab them. So, yeah, there's been more downtown rehab in recent years, which is great, and it's what we want. So, so do we have a consensus on the first point of going back to requiring lender involvement?
Excuse me.
What way we want to go on that point?
I think Dave said it perfectly. You can force them to use a lender, but if they have the money, they can go in and they can pay off that loan the next day. And if they have, say, I'm just using the example, like, okay, I have $10,000 and I need to put new windows in my building because one of them was broken or whatever. I have the money. I want to go get a low interest loan from the EDA for the other half. Why should I be punished and be told you have to go through the hoops? You want to make this easy. The intention of the program is an open to the public opportunity for commercial businesses to improve property, make repairs, and maintain their facilities. So are we in a position to put roadblocks in front of people, or do we want people to be able to come and understand that these programs are here and incentivize them and encourage them to make these repairs when they otherwise might not? And again, if we are lending the money, like it or not, we need to assess our risk, period. We can't rely.
That you think banks are bad and our interest rates are horrible, just, pointing
No,
that out.
no.
Exactly what you're saying, though. You're coming in saying that, putting them all through these hoops. Our background, mine is, the EDA's background is not as a lender,
Correct.
per se.
Correct.
Okay.
But if we are going to lend, we need to assess our risk. I'm not saying don't go to the banks. They're there for a purpose. But if somebody has their own and they're coming to us to help, we don't want to turn that away.
I have no problem with the self-funding part, no problem with it.
the only issue I have with the self-funding part is that the target, the the people we're going for, because if they can do that and they don't need this, then that's going somewhere where somebody who actually does need more help does not have access to a program. And that person might own a building and want to do this work, but can't because someone else came in who could potentially fund the whole thing themselves, but are taking advantage of this program. And that's where bank involvement and partnering with, banks are businesses, and collaborating and partnering is important on all those fronts. I think that having the bank involvement might help us get to the kind of client that has more of a need for this type of program, but is still not a huge risk. And the nice thing with the commercial program is even if, the bank's got the lien on the building, well, at least there's a building involved rather than, the some of the business-only loans where you're looking at splitting up collateral based on equipment that's not going to get you very far when a bank's first and you're second. Here, someone defaults, you have a building to work with versus a tractor.
Right. This program does require a mortgage on the property, and we are behind the bank. If the bank also has or if there's also a mortgage with the bank, we are behind the bank. Some of the properties that get this loan don't have a mortgage. For example, the chamber took a small commercial rehab loan. They own their building outright, so there is no first mortgage. So we aren't behind a mortgage lender in that case, but that's
They self-funded though. They would have self-funded, they would have had to have.
yes.
I agree with Dave. I think the programs work fine, and I've used it in the past. I don't have a problem with the program. The only issue I've had come up in the past, and I don't know if they still do it, at one point we had to do a modification, Dave was involved then, and it had to go to city council for approval at that point. Was that this program? And I just knew that there was something that had to go, and it was probably 10 years ago, and I know
Was that maybe a city revolving
that was probably
loan?
the city
that's what it
revolving
was.
loan.
Okay.
Go to
Because that was the one
council.
where they're like, well, then I don't want to do it because it's,
Yeah.
it's one of those things. Okay.
Yeah,
That was
this-
probably a different program then.
Yeah, this program is all EDA, no city council approval for any of this. If you do want to go still kind of status quo where they can self-fund or use a bank, then I know Heather was asking to set a minimum credit score, so we can just have that in the
Okay.
eligibility guidelines.
For a banker,
Right.
what do they use for that? Bad, ugly, I don't know.
I can tell somebody how to manipulate that number to tell you what it's different 1 month from the next.
Right.
I don't I've worked at places where literally whatever the credit score is, it's a yes or a no.
Yeah.
I don't like that because you need to dive into it.
Yeah.
What caused it? Why? If it's low, why? If it's high, I've seen people with 50,000 in credit card debt have a great credit score because they make their payment on time. They probably don't cash flow, but they make their payment on time. So you got to dive into it. That's why I don't like. We could set a minimum, but I think you need to look at it. What if somebody missed a medical bill payment and all of a sudden they have a collection item? It doesn't mean, but every other payment's been made on time forever.
Yeah.
That one miss is going to destroy their credit score. I think you have to look at it.
And again, I'm not a lender by trade, so
So that's where I have a hard time. If we
want
say
to leave it up to me to dig into their credit report and decide if they're creditworthy, or do you want to set some sort of criteria that I go by? It's a lot to put on me to make the decision when I'm not a lender.
and this would be just for the self-funding ones, right?
That's
Yeah, just
where-
the self-funding ones, yeah.
So then, then we could pick something and.
Be self-funding, an option for self-funding? Or should it require a bank match?
That's the first question you have to decide.
It doesn't now, and I think it's working.
Because I think we've only had 3 or 4 out of all the loans that have been self-funded at this point.
I don't know. Off the
And how
top
do you
of my
track
head.
that they put their money into it? Just receipts and checks? Is that how you do it? That'd be
Well,
my only thing is
they're
make sure
having-
do they have to put their money in first? How do you?
Me quotes for the project that they want to do, and we can borrow half of that. If they're not going to a bank for the other half, you're assuming they're, I don't make them prove that they're paying for their half, but
I think it should require a bank match. If you can self-fund, then you probably don't have as much of a need for this type of program. And it takes away extra work for Heather, extra vetting, trying to figure out criteria, trying to analyze credit scores.
selfishly, that's the reason I would like to go back to having a bank involved, because the bank is then doing that vetting, and if the bank is saying, we're willing to fund half of this, then I'm more at ease saying the EDA will fund the other half, because I'm not having to decide then if they're a good risk or not.
Could we
Well,
self-fund
it's
up
not
to a
half and
dollar
half,
amount?
though. It's not half and half, though. Like if they lend 100,000, we would give 50,000 max.
75.
Because it's 50% of the total loan amount. So if the total loan amount is 100%, we would only give 50,000.
If the total loan is 100,000, do you mean? Correct, yes, then we would only do 50, right?
Right.
Because we can only do 50%, but
Could we pick a smaller amount to self-fund? Say if it's 20 grand or, I'm just throwing numbers out there, 15 grand, 20 grand or less.
Because I would look at it, and from a business standpoint, like you were saying. So if I am a business owner and I have 75,000 to do a repair, and I can borrow 75,000 at 2%, but now you're requiring me to go get $75,000 from a bank, I'm going to have higher interest rate on money I didn't have
But
to
again, they
spend.
could pay that bank loan off right
They
away
could.
if they have the money.
I mean, they could, but it's extra hoop. Then I have to pay the bank fees on top of that.
Yeah, there are closing costs and. yeah.
Again, it's adding extra costs potentially.
Well,
for
if
them
it's
to
not
just pay
bank
the
funded,
loan.
I'm going to do a credit report, so they're going to get
we
the credit
charged
hit.
anyway, and they're going to get that
Either
hit.
way, the credit check either way.
So again, it's do you allow someone who's a business owner that potentially has that cash and say, I need the other half to do the rehab, or do you want them to go to the bank and do the things and potentially? Now that's a philosophical question. My economic development brain is always going to be that economic development side, but as a board, you have to weigh those and make that decision. But again, I'm fine if you want to send a threshold of, 25,000 for self-funding. That's what we'll self-fund up to. I'm fine with that. Whatever you as a board decide is the direction for this program.
I mean, in our situation, it was a $20,000 repair that needed to be done, and we could come up with around 10,000, but we just couldn't wait. And so that's where the EDA, it came in it allowed us to get the work done, and so we weren't talking about a substantial amount of money. It kind of is for our organization, but for others, and it was nice to be able to have that option and to be able to get that quickly. So I understand what you're saying, like you don't want to have to hop in, but I really like Commissioner Lieb's idea of doing up to a certain amount.
Could the criteria be what the loan amount request is? Because for the scenario you're throwing out there, that makes perfect sense. And to have to go to a bank for an extra $10,000 it would just be a hassle and not as necessary in your situation. But for larger projects, say a project that is over, is it $75,000 or $100,000 project, then a bank match is required.
I do like that.
I have a question, and I'm not asking it the right way a few times here, but in the Turner scenario, they should have only received 5,000, according to how this is written.
No, it was a $20,000 project.
Right. So 10,000 should have been matched by 5,000 because it says 50% of the total.
50% of
It should
20,000
say the
is
total
10.
project, not the loan amount.
Yeah, there is some language cleanup that we need to do here. which I will do once we decide where we're going, and then it'll come back for approval, and those things will be fixed.
Right, so
It's
Yeah.
what I
project
want to
amount.
know is, what are we paying, what are we actually
It is
This is a
project
good
amount.
point to get Commissioner Lieb's expertise, is that if it's going to be over a certain number requires a bank match, would you have a recommendation on what that number would be?
Well, I think the 50 is fine, and I think it'll come down to the individual borrower. There's some where they might need only 20%. You know, I get the interest rate thing, so most of them are going to take the 50% because that's, I would too. I just think under C, this isn't written the way the program is. You know, the EDA will contribute 50% of the total loan amount. It really should be 50% of the project. or
That
the amount.
was true, I think, back when there was a bank match required.
But I
Because
understand
then we
where
were
you're coming from,
talking
but
loan- yeah.
if they needed
That's one of the things John
$150,000.
Nisley brought up in our meeting last week. He's like, that should be project,
Yeah,
not loan.
because I know when we did, it was always 50% of the project amount, but not 50% of the loan amount.
Right.
Yeah.
So yeah, John Nisley brought that up as well, and I didn't include that in my notes because I just thought once we decide where we're going, I'll do that language cleanup before I bring it back for approval.
But then once you're at the bank, they don't typically want, the EDA would not want to have more money in it than the bank.
Correct.
And it could be a $400,000 project. We aren't going to do half of that project because we max out at 75,000. So there could be cases where they're getting 325 from a bank and only 75 from us because we hit that cap.
But then
So it's not
wouldn't-
always half of the project either.
With a cap
Up
amount.
to,
Up to.
yeah.
Wouldn't you want the language to still read 50% of the total loan amount so that you're not coming in higher than the bank?
We want.
Up to
Could we add another,
$75,000.
when there's a bank loan involved, this happens, when it's self-funded, this happens? Then you could say 50% of project, or you could say 50% of total loan amount.
I still don't think we're talking the same thing. Then you're really saying it's only funding 33% of the project, which is not the way the program's been. It's
No,
been 50/50.
it's
Yeah.
50/50.
Up to 75.
Mhm.
I think the wording is just
Right.
not accurate
Yeah.
on there.
Instead of loan amount, it should say project cost, up to 75,000, yeah.
Then you could put in there that the EDA portion is not greater than the bank portion.
Yeah.
I mean, you could put that wording in.
And if we really want to split hairs, it's up to $74,999 because 75,000 triggers additional reporting requirements. So we always, we'll come in at like 74,900 or, you know,
Not
we,
to exceed, then, that's what you say. And then just real quick, in D, I think that we should move all that language. It says under special circumstances, a longer amortization period can be negotiated, but not to exceed additional 5 years. That just opens another can of worms for us. I think it should be 10 years. If you can't get it done within 10 years, like, we're not your people.
I was wondering about that too. I've never had anyone ask to go longer than 10 years. I didn't even really
just
know
wait
that
till they
was an
do.
option until I started looking at this and I'm like, what?
Yeah.
But yeah, I agree that maybe should be removed.
And then, do we want to require a commercial real estate mortgage? Are required? Because we did one for a business that doesn't have a mortgage too. You know?
That's our mortgage that we're putting on the property
Okay, I
to
got
cover our loan.
it. Okay.
We require a mortgage on the property, a promissory note, and a personal guarantee.
That makes sense. And then nobody touched on the interest rate. I just want to say that I still am good with 2%, but if you wanted to move to something like a 2.5%, but to try to match,
Well, the interest rate at the bank changes, changes, so
yeah. So I
we have
just
to
want to say the
evaluate it almost
2%
on an annual basis if we
I'm
want.
fine with, because it's easy to communicate and understand and calculate and everything else, but I wouldn't be opposed to raising it to something else very adjacent to that number, but
And the 10 years can deter some people to not take as much. Because, a bank might go 20 or 30. But I understand with us, EDA being in a third position, let's call it, we want to protect that and get the faster repayment. I get that. But that's another reason that maybe they
'Cause that
would go with the
monthly
higher interest
payment.
rate just because of the cash flow part of it.
So just to kind of recap what we have said, we do want to require a bank, except people can self. Did we say a number? Did I hear 50,000?
We haven't said anything, but we
Okay.
can say a project costs up to and less than 50,000, so then our portion would be 25. I'm just throwing that out there, we can, right?
Thoughts, commissioners,
I think that sounds
for
good.
self-funding?
So I just want to make sure I heard that right. For projects $50,000 and less, we would not require a lender. And the EDA's loan would be 25,000 or less
Half
in
of the
those
project or
cases.
less.
Yeah, okay.
And do we want to give Heather guidance on how to vet those loans?
Yeah, so for those lower project amounts where we wouldn't require a lender, could we set a minimum credit score? And Chris, I know Chris had thoughts on
Yeah, I mean,
that.
for me, I would say at a bare minimum, I would go probably around 600, but we can set it a little higher. And, with, let's go my limited loan experience, I can dive into the credit report and dig through some stuff as well. But if you want to set just the bare minimum, so if we deny someone because it's below that, and we can't find anything really discernible, and maybe that's one that we would bring to the board if we find something in there that's like, yeah, they're below the threshold, but here's a couple factors, we can bring that to the board for approval. I could see something like that where we find something, but really whatever you kind of, Mike, lean on you. What's a
6 is low.
yeah? I know, I know.
I look at my hat on, I'm like, let's say 650, but if my loan to value is less than 50%, do I take that risk? Yeah, absolutely.
Yeah.
So it's more than just the credit score.
Yep.
But if we need something, I'd say at a minimum 650 and
Okay.
go from there.
Okay.
You can always bring it to the board,
yeah.
right? Or is that what you're trying to get rid of?
So I could approve it if they had a credit score of 650 or higher, but I would have the option to bring it to the board for consideration if it's lower.
Perfect.
And we have reason to bring it to the board or potentially approve it.
So board approval needed for lower. Okay. Okay, so on the first question, going back to requiring lender involvement, yes, unless the project is 50,000 or less, or no, I guess we're talking two different things. Lender involvement, okay. And we don't want to go to the gap loan. We're going to just cross that off. We don't want to have it be only if they can't get it from a bank and there's a gap. We don't want to go there, right?
We're kind of serving that purpose anyways. It's just so.
Okay. And then if not requiring bank involvement, minimum credit score of 650, board approval if it's lower than that. So we're good so far? Are we okay with removing the board approval for loans over 50,000 if they meet the criteria for the
I'm
program?
okay with it.
Yes.
Wonderful. And we're okay with the 2% interest rate?
I would say. Did a quick calculation difference between if you went from 2 to 3 over a 10-year period would be about $4,000 If you wanted to go to 3, we'd roughly get, and they maxed out at 75, you'd roughly get $4,000 more than you currently get at 2%.
Nicole, just out of curiosity, what do we get right now for the money sitting in the bank?
It changes every month. It's based on the 3-year treasury, and then we get 25 basis points above that. So right now, we're just under 4% as of February 1st.
So we do get more money in interest if it's sitting in the bank. However, if it's sitting in the bank, it's not serving the community either, so.
Right, and I think the huge advantage, of course, is the 2%. That's where we're really helping people.
And to me, at 2, it helps blend the rate too. So if a bank is at 5 or 6, then you're at 8. You're technically at 4% for the life of your loan, blended rate. So it makes it a little more manageable.
There's nothing stating we can't change that in the future, right?
Yeah, I mean, we can look at this
Review it every month if you wanted to.
No,
Thank you.
or maybe making it an
I say
annual
no
thing in January when we kind of refund the programs. We can add interest rates of our programs to that as well and have that discussion there too.
Did anyone else have anything else they wanted to bring up for this program before we move on to the next?
I just had a question on the second page on number 3. It says the loan amount must not exceed 100% of the eventual market value of the structure to be improved. Just,
You can order,
Right
so if you have a rehab loan or a remodel loan, you can get an appraisal as completed. So it might be only worth 200 grand today, but after what you say you're gonna use the money for, it's 400. So we might borrow 300, even though today it's worth 200, but in the future it's 400. I think
Okay.
That's what that's.
Yep.
so do we feel like that? I don't know. That was one thing I was just like, what does that mean for us? Are we actually doing anything?
I would say
Never had to use that calculus in approving a loan.
one of the base examples, is the Lamplighter building, looking at remodeling that. If you're going to do a kitchen and all that stuff, that loan you're never going to get market value for that
Right.
loan. It's kind of getting us out of that business where we know if it goes under for whatever reason, we may not get anything back.
no speculation.
Right. Love it.
The only other, you probably caught this already, point is it refers people to the second floor of the city hall to get the documents. I'm going to assume we go down here now.
What page is that? Oh, I see that, yeah.
It's in the other one too.
Oh, yeah, I did read that too.
Would have caught that as I
Yeah.
went through this. So I think I'm in a good place that I know what I need to do to bring this for approval next month with the changes we talked about today. And we can move on to the small business loan, which should be a easier and shorter discussion. Dave wants to be out of here by 10.
No, she's going to pass it out.
Oh, okay.
She's passing it out.
Thank you.
For the government loan program, so. I mean, there's ways to look up what, and how you, I mean, like you said, you have loan experience, so you probably know all this anyway.
Okay. This is now the small business loan program. This is newer. It started when Chris came on as Economic Development Director, if I recall.
Yeah. So this one was just born out of, we had a limited loan program that was tied, strangely enough, the same funding source as the commercial rehab program. It's like 2 loans in one. And when COVID hit, we really changed it and kind of pivoted to being a small business loan, kind of a micro loan for businesses, because the limited loan program was rarely used. I know Heather's probably done a couple the best example that I had with the limited or the small business loan program was Red Dragon Gaming. They needed $2,500. No bank was going to, give them $2,500. And we were able to get them the loan within 30 days, and they were able to open, and we're pretty successful business, and we're able to repay the loan. So part of one thing that I know Heather's going to ask, at least for this loan program, is to carve out a portion of funding from the commercial rehab and set this up as its own
Fund.
revolving loan. So it's not commingling, and if they're out of commercial rehab, then we can't do any small business loans. And I don't know what number that's going to be, but kind of carve it out so it's its own standalone program. Because I would say out of all our programs, the small business loan is probably the one loan that will touch all our businesses. And what we hear the most is that we don't do enough to serve businesses that are currently up and running. So we can get them started, but we kind of don't have the gap years, and this program, in my mind, kind of serves as that gap, after they're starting, kind of financing for them.
I think with part of the strategic plan initiative being helping with some of that gap financing, that this program is a good opportunity to provide that. I will say, though, in terms of small businesses, if you're looking for gap financing, or say you need to replace equipment because it's 10 years old or whatever, 10,000 does not get you very far. If there are funds available, if this can be its own program that's a revolving loan that's not lumped into the commercial rehab loan, that my suggestion would be to raise that to at least 20,000. If it's possible to offer more, offer more. And this is a 2% loan as well.
1%.
1%.
1%, 5-year.
Okay. So maybe it's 20,000 at 2% or 25,000 at 2%. But this is one of those things where you're at the bank, you put this much in yourself, you have bank financing, you've got the EDA match, and now you just need that last whatever. This could be very useful in that case.
I can tell you a couple examples that this program's been used for since I've taken it over. We had a local restaurant who their walk-in cooler went out and they needed to replace it. That was an unexpected repair, and restaurants don't have a big profit margin, so they came to me for a loan and they were able to get that replaced. Similar situation, a local florist had their refrigerator go out and flowers need to be refrigerated, so they took the loan. And then more recently, well, two more. A local chiropractor wanted to buy a piece of equipment to expand what they were able to offer, and they used the loan to purchase that equipment. And then I had another business that used it to cover payroll with kind of the things that were going on with tariffs and cost of inventory spiking. Just wanted to kind of have that cushion to know that they could cover payroll if needed. So, and those are all existing businesses, not startups, that had been in our community for many years that had a need, and we were able to help them out, and they really appreciated it. So, one easy way, I guess, or in my mind, an easy way to split this money out would be to take the people that currently have one and just start, as those payments come in, put them in its own account to create that revolving loan. And when enough funds build up that I can loan it out, Nicole's nodding as the finance director.
Do that, look at that and
So rather than
analyze
just
that.
take, 50,000 of the available funds in the commercial rehab loan program and move those over, we could just start taking those monthly payments and putting it into its own fund to be lent back out. that would be one way to split the funds. So yes, that is my first ask, is to split it into its own unique fund, separate from the commercial rehab loan program, because it just gets, one person comes in for a $75,000 commercial loan, and then I can't give a small business loan for 6 months because the money's depleted, and I have to wait for those payments to come back in. Another suggestion I would make is currently we don't require a credit report for these loans, which, at $10,000 probably was, but especially if we're going to look at increasing that amount to 20 or even 25,000, I would want to run a credit report and then have a minimum credit score for approval. These right now are the quickest and easiest loans to get. They apply, I have money available. I send the information to the city attorney to prepare some simple loan documents, and they can close within, 2 weeks of application. So they're very easy, maybe a little too easy. And so, like I say, I would recommend running that credit report just to make sure they don't have like a 400 credit score or something.
I have a question on the two loans that we are talking about today and how it aligns with our strategic plan, because looking at the strategic plan, when it talks about these two loans, it talks about the need for capital for expansions or startups. And I'm wondering how we see these loans fit into the needs of expansions or startups for business, or do we say we don't want to do that, we want to fund buildings? And what is the purpose of these? What do we want to accomplish? And maybe it is that we're just being friendly to business owners who aren't startups to help them with fridges and freezers. And if so, let's know that that's why we're doing this. But if we truly do want to expand expansions and startups, do we need different criteria that we talk about here?
And I misspoke in the gap financing portion for someone going and looking for funds to even get their doors open. This is, right now as it stands, is for businesses that are currently already open.
Yes, and I have denied applications. I've had someone trying to open a business and they want money for inventory or whatever, and I've said, until you open your doors, I cannot give you this loan. But the day you open your doors, you can apply.
Well, I'm looking at the resources that we have for emerging businesses. I mean, we have Wendy Anderson, and we have, the chamber that businesses can lean on ahead of opening. But yeah, once they're open, I would say, looking at what we have here on how they can use that loan. Like, I'm picturing right now, like doing some technology upgrades. And so, that's kind of building improvement. So, I mean, it could technically be either loan. So, I mean, is there a way that we want to kind of better define this? I guess I agree with Michelle a little bit on that.
Starting with what's the intent of the loan? Is it for,
Keep your doors open.
yes.
Right.
Is it for more geared towards existing businesses, or are we more gearing it for anyone, startups as well?
Can it be all?
I would think they would need to be open first.
Yeah.
And operating.
That would be the main question.
Yeah.
Are they open?
And I'd like to see a threshold. I open my doors tomorrow, and tomorrow I can apply.
Right.
I would like to see
The way the
time frame.
loan stands now, that is,
That's what, we have resources for them to get off the ground on the right way. I mean, I do think they should be open for at least 6 months or 12 months, or I don't know, you're the pro, I don't know.
I would say, my recommendation would be over a year, we allow them to apply for the startup grant within a year. So this, if you wanted to continue, this is for, business continuing on, I would go, at least after a year. So
I like the 1 year mark because if you can hit that 1 year mark, your chances of
success. are
continued
good.
success are better. Yeah, survival. That's,
It goes up after 3 years as well.
yeah, that first year is the
A hard year.
And all of those scenarios you provided probably did not happen within the first year of operating for those businesses. I mean,
That's probably a
Accurate statement.
pretty true statement. I can't 100% say yes, but for the most part, yes.
I have to put a different hat on when I look at this, because this isn't, it's, rent is eligible reason. If we're borrowing money, we talked about our risk assessment previously on the other program, and if we're giving people money for their rent we're risky if you're giving money for rent. I mean, and I get there can be situations, the tariff thing, or maybe it's a timing thing, you're a seasonal business, but I was on the Brown County one as well, so I have to look at it a little differently. But I like the year thing. I'd like the interest rate to be consistent with the other program, 2%. I don't know if I'd like to go higher. The only reason I say that is I have a problem when the government, us, try to take over lending at other businesses. I'm just one of those that I think should be a separation. That's just my thoughts.
Well, yes, because we're not trying to compete with the banks. We're trying to provide incentives. Economic development is all about going beyond that, to give you an incentive to stay in business, start up a business, and unwritten is not to compete with banks or other lending organizations.
So I was just looking, do they file it just says appropriate assets acceptable? What do you take for an ad? Do you file a UCC filing on their assets, or do you just
We
shake a
have.
hand and?
We have in the past. So specifically, when we did the loan for Red Dragon Gaming, I had 2 cars, cameras, equipment. We did
Porn.
we did the UCC filing on some of that stuff to collect the collateral if
Okay.
they went under.
Is firstborn worth more than the third one?
Sometimes you give them away. Sometimes you give them away.
So just to clarify, this is not just for startups, it's also for existing, but they have to be in business for a year? Or what?
That's what we're,
That's what we're looking at now.
Okay.
Is
currently, they just have to be open,
Yeah, okay.
but we're proposing changing that to open 1 year plus.
Okay. Thank you.
Also, it has to be a small business. So
Under 20.
lenders are still going to be there for the ones that don't qualify based on full-time equivalent employees.
I'm sure. What's the question?
I'm just saying, medium to large employers that need a loan are still going to have to go to a lender because this is limited to small businesses.
I would. Is that what the strategic lines with the strategic plan? I mean, I can't imagine we should be giving $10,000 to a place that has 40 employees. I just don't think that's
Yeah.
what the EDA should do.
Right.
Somebody else has other thoughts.
It's for small businesses, so yeah.
20 or less full-time equivalents.
Yeah.
I've also had a couple small businesses use this who maybe used a credit card to make purchases for their business, equipment, computers, something like that. And then they'll use this loan to pay off that high interest credit card, to help their business better cash flow. I'm just trying to think of some examples of how it's been used.
I would agree with 1 year open, increasing the interest rate to 2% to align it with the other one. It's still a very, very excellent rate. And keeping that cap at 10,000. I mean, we're right. We're not, it should be a smaller loan for small business, I guess.
You want to keep it at 10 or go with a 15 or 20?
How long has it been at 10? How old is this?
So yeah,
I think-
2020 is when we kind of revamped it into the small business loan. And
It
usually
used to be 2,500, then I think it increased to 5,000 and at some point to 10.
10, yeah. Because when we looked at like a commercial burner for like restaurants, I think that was kind of the threshold and kind of we looked at.
I think Chris raised it from 2,500 to 5,000 when he started as economic development director. And then I think when Audra was the economic development director and we were dealing with COVID, the decision was made to increase to 10. And I think leaving it at 10 is fine because it is really just a micro loan. If we started increasing it to 20 or more, then I would want to require some sort of collateral. You know, right now we really don't. But
I'm okay with leaving it at 10 for now.
So my only thought on that is a $10,000 loan worth the time, work, energy? Or could that money be redirected to a program that's going to have a greater impact?
I don't know. I mean, I do typically 3 to 5 of these loans a year. So on the business owner's side, their time and effort, there isn't much time and effort involved, to be honest. And they must feel it's worth their while because they're applying for them and taking them.
I have a similar question.
Not for the business owner, I'm saying for staff and the EDA.
These are the easiest for me to administer. I take the application.
About 2 weeks.
Even if we're adding the credit report, that's online, instant. And I send everything up to the city attorney and they prepare loan docs. So.
My question is the economic impact to New Ulm. Like we're making these loans, what's it doing to increase the impact?
Well, I think it's helping our existing businesses stay open because if they're having, an unexpected repair that's going to hurt their cash flow, we're keeping them open. A restaurant can't operate without a refrigerator. A florist can't operate without a refrigerator. A chiropractor needs equipment to offer services,
but they could go to a
So
bank
we're
and get
supporting-
an equipment loan potentially.
Be tied up. They could have they might not be in the position to get another $10,000 loan for a quick fix because maybe they just got their loan for $200,000.
and the 2% interest keeps that
Yeah.
monthly payment affordable too, and again helps with their cash flow.
I'm not saying I disagree with it. I just want to make sure
Mm-hmm.
we're doing it for the right reason, not to feel good.
Yeah, I just think overall it barely puts a dent in what
I agree,
businesses
but
might
for those
need.
larger needs, then they probably need to go your more traditional financing.
But then in, like Shar
This
brought
is
up,
a micro loan.
if they can't get that from a bank, then, so a walk-in freezer, your example, a walk-in cooler, those cost like $30,000. So this covered 10 of that. And then where'd they get the other 20? And this is just a,
Well, hopefully they
example.
had some reserves, in the bank if their business is profitable. They should have some savings.
Well, along with what Lindsay is saying, I think we've seen an uptick in cost of everything in these last years with inflation significantly for equipment. And so even going to 15 seems like more realistic if you're looking at, I'm looking at a furnace replacement or let's say air conditioning at the Unique Center. If I don't have air conditioning, I'm not going to have weddings in the summer. And the quote I have now is higher than 10,000.
I don't think a lot of small businesses probably have a great reserve. Most small business owners right now aren't even paying themselves. So
Right.
again, it goes back to what's the intent, and it could be left as is, and that's fine. I'm just saying, if you're looking at it through the lens of someone operating a small business, it's very minor, the amount of relief you get from a $10,000 loan, to the point of almost being inconvenient. Not inconvenient, but is it worth it? Do I then just say, okay, I'm going to go to the bank or try other avenues to get something that's going to be more impactful for my business? Or what's the extra legwork involved if I'm doing one loan at 10,000 and then going to a bank to finance the other 20 for a piece of equipment? It's,
You know, listening to the conversation, I'd be all right with going to 15, you know, economic development, or is this loan to keep the economy going?
Both.
Want to keep that business open, or they just went defunct for 6 months? Can't quite afford that fix?
Then they're done.
That's how I look at it. I mean, I understand the economic development, but also keeping the economy or the business owner open. Some of those impacts, they close. I don't have a freezer. I don't have, we're not open 5-6 months.
So we're at 10%, I'm sorry, 10,000 at 1%. Would we be okay with going to 20,000 at 2%? Would that help?
I'm all right with keeping that across the board. If we're 2%,
2%.
it's 2% for X, Y, Z.
All right, well then if we're going to stay at, then yeah, I think we should go up a little bit. We don't have to go, if they need more, then they can go those other routes. But this is really going to help again because a bank's not going to give you 1 or 2%. So you're still really helping, even if it is 10,000. But we probably have more of an impact helping out at 15 or 20, I think, as well.
10,000 will help, but that's a very short-term temporary Band-Aid. And that business might still close 6 months later because it's just not, it's hard to continue to put Band-Aids on in this.
Yeah, and that's a good point. I mean, inflation has really
Yeah.
changed things in the last couple of years, so that is a good point. Are we comfortable with 20,000?
15 was suggested too as a middle ground and reassess, but I don't know what.
So what's the purpose of this fund or this loan program? I mean, to me, it's always
Chris,
seemed
take a
like it was
stab
sort
at
of a gap or an emergency or a, I go back to, we were talking about risk assessment, the last program. Well, we're going to increase this, and this is probably your riskiest program, because what do you have?
Yeah. So,
You know,
Mike, you're 100% correct. The small business loan is always going to be your riskiest program in any EDA. It is, you know, for emergency, like most of the stuff we get is for emergencies. I would look at this as, you know, hey, Christmas is coming. I need $10,000 so I can get more inventory, you know, to stock up the shelves and, you know, pay the loan back when I sell all my inventory, things like that. And so that's why they're usually kept a little bit low. So I would agree if we're going to go up, 15,000 is probably where my risk threshold is. But it really is to help those businesses that just need that little extra to help them do things. But it's not there, you know, to be, here's 15,000 so you can stay afloat for 30 days and then, you know, and maybe we take rent out as something, you know, look at what's eligible activities and kind of, you know, I would keep payroll in, you know, the technology upgrade, stuff like that, and maybe get rid of rent and utilities. Because if you can't pay rent and utilities, maybe that's a risk we don't want to pay, but there's always unforeseen circumstances too, right? Oh, I spent all my money getting my fridge. I need help paying rent and utilities. But what we can do, not that the conversation is over now, but we can, between Heather and I, we can take the feedback, at least on this, draft something up, bring it to the next meeting. And if you're still not comfortable with everything there, we can still massage it and stuff. But, it really is, the purpose of this is really helping those businesses that need that emergency influx to, potentially purchase equipment or something bad happens, or I need extra inventory that boosts because I know Christmas is coming or something like that. Let me just get more inventory in my store that I know is going to sell so they can be a little more profitable during holiday seasons and things like that.
And I just want to say there are some small businesses who have taken this loan in the past who have closed but continue making their payments. I haven't had one of these default. Sometimes I've had someone fall behind on payments, but we work with them; they get caught up. I haven't had anyone straight out walk away from their obligation.
Because at 10,000, that's doable. I mean, you can,
That was my other point, is
Yeah.
if we keep going higher, at some point, it's easier to walk away than it is to
You're
keep
right.
throwing stuff back. I would just only, on D, I know you said you were gonna look at this on here. It says could include, well, that's pretty vague.
Right.
It doesn't even say equipment. It says,
Yeah.
so basically you can use it for whatever you want, is kind of what we're saying.
Yeah. But we can shore that up, make a more detailed list of stuff.
More of a not to include than what it includes.
Yeah.
I mean, once they get the money, I really can't dictate if they take the money and pay their rent with it. I can't.
But we should still
can't
put
really
it in there just to
control
have it,
that, but-
I think.
I think taking it out of there as examples is good.
Yeah.
I would say do a credit report again. I mean, this is your riskier one. I would do the credit report.
Yeah, and basically that would be adding a fee. I think it's $12 for me to run a credit report. So they would have to give me a check for $12, give me their social security number and what I need to run their credit report. And then are we wanting to keep that minimum score of 600 like we did?
650.
Or sorry, 650?
I would say, again, it's a risky loan, and it doesn't mean you couldn't have a conversation and get an in-depth review, but you need to have at least 650, and even then, like Mike said, there's so many things that go into that, but.
Knowing that 10 grand isn't going to make or break a business, is this a program we want to then keep? Because in the scenarios you brought up were very valid scenarios and good scenarios. But if it's not gonna, big picture, keep that business around or make a major impact in terms of retention, could those funds be better used elsewhere that has a broader, more long-term impact?
I like the fact that there are some small caps on that can help with some of those emergencies. So like to roll this, to kind of get rid of this and then roll it into like the whatever small business rehab program or something like that, where some of those things might not qualify. I don't know. I still think that this serves a pretty good purpose, just only based on the examples that you gave us. So.
Again, it goes to what do we want to accomplish with this?
Yeah, because I would pose that question to the board, and maybe that's food for thought over the next couple months. Really think about what is it, because we always said it's not making an impact. Well, what is the impact you want to make? I don't understand what that phrase means when you say it's not making an impact.
I'm not, and let me
Yeah.
correct that.
Yeah.
The impact is short-term. It's a quick fix.
Yep.
Is that the goal of the program? I'm not saying that's
Yeah.
wrong. Is that the goal of the program, or do we want to use funds to make a more long-term impact? Because if you're a business that needs a quick $2,000 and uses this program, that's going to short-term solve the problem. long-term, those problems just get bigger. So
Potentially. You know,
it's getting bigger for business owners constantly. That's only getting worse. So I'm not saying one is right and one is wrong. It goes back to purpose. And are we here for a quick fix in a pinch, or do we want to look at how we can make things more sustainable and efficient over time?
I would think that even though we think of it in terms of quick fix, I look at it in some cases as an emergency, like Andrea had brought up. You have a situation like, or if a cooler goes out, it's not necessarily a quick fix as much as it's bridging you to, you know what your cash flow is, and if you could spread that out over the next 5 years or even a couple of years, it gets you to a place where you can be more viable. And so I look at it not necessarily a quick fix, but in some cases an emergency fix where you don't have, that wasn't planned on, and yet you can get to another place with that.
So do you think we should make this more specific to emergency? I mean,
I know we talked about equipment as
Emergency
one of the options. I
loan?
don't know.
I mean, you could go that route, and you know, to your original point, you know, the EDA as a whole, we're going to have to play both roles as a short term and long term, because the business community ebbs and flows, right? You have your long term goals, you have your short term goals, but what I think a program like this does is it shows the business community, because depending on who you ask, we are not a business-friendly city, and we are a business-friendly city. I know we're much more business-friendly than Mankato, but when you have programs like this, it shows the community that we care about our businesses regardless of size, regardless of who they are, and it builds short-term into long-term, because we're investing into the community. I mean, every year we're $600,000 at least into the community. So again, it's like, I understand, you know, the premise of, yes, it's potentially a Band-Aid for some, and maybe those businesses don't last, but, you know, when we look at our grant program since 2019, 10 of those have closed, and a couple of them had been around for 4 or 5 years and then finally decided to call it quits. So, you know, looking at a program like this, we could put emergency provisions in there saying, yep, here's the thing. But I do like it, you know, for businesses that want to bolster inventory for specific times of year. They just need that little bit of influx. Because I was throwing around the idea of doing some type of, you know, I'm not going to call it a revolving, like a line of credit for, you know, businesses during, you know, holiday season or something like that. But this program kind of serves as that purpose if they want to take advantage of it in that way. You know, I do agree with the changes to do, you know, 2% just be consistent, put a little more skin in the game. You know, we can, if it's for equipment, we'll file the UCCs to really cover us, because it is a more riskier program and things like that. But when we look at economic development, it's a weird hat. It really is. And that's always the hardest thing, because, you know, my banker hat, and I get that. I have to think I'm on the opposite end when I'm in a room full of bankers and I have to put on the banker hat and not the economic development hat when I sit on loan committees. And I'm like, wait, okay, no, yes, I understand what you guys are saying. You know, and that's part of, you know, Michelle, you bring up good points. Is it in line with our strategic plan? You know, we all have valid kind of input on this, and it's collecting that, getting that collective and agreeing on something that's, again, going to be help the business community. And I think you guys do a good job of that. And you bring up questions that we all have to look at. You know, it's different lenses, business owners, you know, nonprofits, you know, economic developers, city staff. And so, you know, I look at this as just one of those ones where we have to be okay with the risk that's there, potentially, and, you know, really look at, it is a stopgap, but for some businesses, it's that initial contact with the city. They're like, yes, this city is behind me. I want to do business here. And then it's kind of spread that out over time.
Yeah, it's kind of that economic gardening concept
Right.
with supporting the businesses we have rather than trying to recruit new.
Yeah.
This is one way to do that. And, you know, I'm just looking at in your report, and you can look at this on your own time, in the economic development report where we have the commercial loans, they're all on one spreadsheet right now because they're coming out of the same fund. So any loan with the terms of 120 months, those are your commercial loans. The 60-month loans are your small business loans, and those are mostly the $10,000 initial loan amount. Most of those businesses are still open. I see 2 that are not, but they are still making their payments, even though they closed for whatever reason. And I don't think those 2 businesses that closed because the $10,000 loan wasn't enough to keep them open. I think they closed for other reasons. But they're still making their monthly payments. Like Chris said, we get a lot of feedback that, okay, the small business grant is great for the new businesses starting up, but what about me? I've had a salon in town for 30 years. What about me? What are you doing for me? Well, this is one of those programs we can say, this is here for you if you need it.
Any further discussion?
All right with upping it to 15? I know that was preliminary.
Yeah, we'll draft it at 15 with the new terms, and then we can have that discussion when we bring it back.
2%.
Yeah, 2%.
Interest and requiring a credit report with a minimum score of 650.
Yeah, and then-
That's what I
Here,
have in my notes.
open and.
Open for 1 year and
Stating
removing
no
rent
rent or
and
utilities.
utilities.
And then we'll do UCC filings on equipment, just so that's in there and they know.
Is that currently in here, or do we need to add that?
I think we need to add it. I know I've done it without it being in, the UCC filing when they do equipment and stuff. But we'll make sure it's in there so they know.
Can you tell me, what does the UCC stand for?
Uniform Commercial Code.
Yeah.
Okay.
It says that it's like.
Collateral.
Okay, so you can take the equipment if they stop paying their loans. Okay.
Boring section of your business.
Yeah.
It has to be filed.
Credit report, it
at-
means,
Secretary of State.
yeah.
Yeah.
Okay.
Yeah, it's a form that,
It's like $26 or
It's
$8.
$20 to file,
Yeah.
$20 to terminate.
That's
Add
great.
into that they'd have to pay that fee.
Yeah, I think so.
Shows that they're, like, anybody else that pulls the credit report can see, that they have collateral.
We don't charge, just so you want it from Mark, if it's a commercial purpose, we just charge for the filing, $20. Because after 5 years, they lapse.
Yep.
So on a commercial purpose, there's no reason to continue them.
Okay.
If you continue them, it's another $20 if you get a loan for more than 5 years.
yeah.
But we just even if they paid off in 3 years, we just let them out there and lapse unless they want it terminated. And usually nobody does. It just goes away after 5 years. So
Yep.
Okay.
you can do whatever you want.
Do you feel you have enough
I think
direction
so.
for the
So
both?
I'll bring the draft of these changes to you for consideration at the next meeting. And then if they get voted, if they're approved, great. If we need to do some more tweaking, we can do that and bring it back again. It'll just, we'll see how it goes.
Do we, on this last one, and maybe I missed it, we have them sign a personal guarantee as well or not? I don't think I saw that on here. I wonder if we should do that as well.
I
Yeah, we can do
think
that.
we do.
I think we do. I don't think it's stated in
Sorry,
here,
no.
but I know we've done personal guarantees. I've done it on this one. Yeah, we can add that.
It is in here on the very last page E. City attorney will provide promissory note and if needed, a personal guarantee. Well, maybe we take out if needed.
You go, Michelle. You got that.
Clarification, when, if this is approved, do they go into effect in 2027 or immediately?
Go into effect immediately upon approval.
Yeah. It would just be updated guidelines to the current programs. So any loan that hasn't been approved or isn't currently in the process would be subject to the new guidelines. Anyone that is currently being processed would be subject to the original ones.
Thank you.
Is part of what you'll be preparing, having this be its own
Yes.
event? Okay.
Yeah.
You're separating it out.
Yep.
Okay.
Any further discussion? All right, thank you for your input, everyone. This work session is adjourned.